A sudden 16% plunge in silver is not a glitch. It is the latest chapter in a cycle Wall Street rarely admits exists. Official stories blame market panic, but history reveals a pattern of engineered collapses where powerful exchanges rewrite the rules in the middle of a crash. What really triggered this crisis? And who stands to gain each time silver melts down? The answer begins decades earlier, on a day that rewrote the future of precious metals. March 27th, 1980, the silver market opened to chaos. Overnight, the commodity exchange, COMEX, issued an emergency order, and from that moment, traders could only sell their silver contracts. No new buying was allowed. The rule hit like a thunderclap across the trading floor. Within hours, silver's price collapsed from above $21 an ounce to barely $10 an ounce. Headlines screamed of fortunes lost and panic spreading through the financial world. The Hunt brothers, who had spent months amassing one of the largest silver positions in history, watched their empire unravel in real time. Margin calls flooded in, forcing anyone with leveraged bets to liquidate at any price. The exchange's edict turned a crowded market into a stampede for the exit. By the closing bell, half the market's value had vanished. The official justification was to protect the system from collapse, but for thousands of traders, the only reality was devastation. This single rule change didn't just move prices, it erased them, and it cemented a lesson that still echoes through every silver crash that followed. On the trading floor, the rules were not just written in the exchange handbook, they were lived minute by minute in the chaos of every price swing. One former COMEX clerk who spent years in the pit described the moment liquidation-only orders came down. It was like someone hit the brakes on a runaway train. You could not buy, only sell. People were shouting, but the only bids left were ghosts. The official line from the exchange was always the same, citing systemic risk, market integrity, and the need to protect the whole from the danger of a few. But for those on the floor, the lesson was something else entirely. When the rulebook changes mid-game, it is not just numbers that vanish, it is trust. This memory did not fade as the years passed. Instead, it became part of the DNA of every modern market. Today's exchanges, whether they are run by humans or algorithms, still reach for the same tools when volatility threatens the system. Emergency rules, margin calls, forced liquidations are not relics of a wilder era. They are standard responses, triggered by models and committees, but rooted in the same logic that once silenced a trading pit. The mechanics have changed, but the playbook remains. Every time the price of silver surges or collapses, the echoes of those old decisions ripple through the screens and servers, shaping the market's next move. Dealer hedging is the silent machinery behind every major move in the silver market. It starts with a simple transaction. A bank or institutional dealer sells call options. For example, 1,000 contracts are sold to clients who are betting on a price rally. Each of those calls carries a delta, a number that tells the dealer how much price exposure they have taken on. If the delta is 0.25, selling 1,000 calls means the dealer now needs to hedge as if they are short 250 futures contracts. To stay balanced, the dealer buys 250 silver futures. But as the price of silver rises, the delta on those calls climbs. A move from 0.25 to 0.4 means the dealer's exposure jumps to 400 futures. Now they're forced to buy another 150 contracts just to keep pace. This process is automatic. Algorithms scan positions and adjust hedges in real time. The higher silver goes, the more futures the dealer must buy, amplifying the rally. If the market suddenly reverses, the same math works in reverse. Deltas shrink, hedges are unwound, and those same dealers start selling into falling prices. In a thin market, these shifts can overwhelm the order book, causing prices to gap down sharply. Every adjustment, every futures trade, is a mechanical response to risk, not a human decision, but the output of a system designed to stay neutral. The numbers do not care about headlines or sentiment. They just react, feeding pressure into the market with every tick. The result is a feedback loop that can drive prices higher on the way up and accelerate the plunge on the way down. On a busy options desk, the rhythm of the market is determined by numbers, delta, gamma, and the raw speed of price changes. When a bank sells 10,000 call options on silver, each contract starts with a small delta, maybe 0.1. That means the dealer needs to hedge by buying the equivalent of 1,000 futures contracts. If silver's price rises, the delta on those calls does not just climb, it accelerates. A move to 0.3 delta forces the desk to double its hedge. buying another 2,000 futures just to stay neutral. The higher the price, the more aggressive the buying gets, all driven by algorithms that recalculate exposure in milliseconds. A senior trader describes it as riding a runaway conveyor belt. When gamma spikes, every uptick forces your hand. You're not choosing to buy, you are compelled by the math. The feedback loop becomes relentless. As more futures are bought, the price rises faster, which in turn pushes deltas higher, triggering even bigger hedges. The cycle feeds on itself, drawing in more momentum and squeezing liquidity out of the market. In a thin book, even a modest rally can snowball into a vertical surge, setting up the conditions for a violent reversal. But when the rally stalls, the same mechanism flips. Deltas collapse, hedges unwind, and the conveyor belt reverses direction. Dealers who were forced buyers on the way up now become forced sellers, dumping contracts into a market suddenly starved of bids. The result is not just a correction, it's an air pocket, a mechanical plunge that leaves no time for human reaction. The math does not pause for sentiment, it only accelerates the outcome, with every tick amplifying the pressure until the market breaks. Margin. Notices hit inboxes late Friday, demanding 36% more collateral from traders holding silver futures. For small investors, that meant scrambling to find thousands of dollars in hours or facing automatic liquidation. One retail trader described watching his account drain in real time as the system sold his contracts at fire sale prices. The math was simple and brutal. A $10,000 position now required $13,600 just to stay open. With markets gapping down and no time to react, portfolios that took years to build vanished in a single afternoon. The exchange's decision, justified as risk control, became a trapdoor for anyone who could not meet the new margin. What began as a technical adjustment on paper ended as a personal financial disaster for countless ordinary traders. Industrial demand for silver does not pause when futures markets crash. Every day, factories need metal for solar panels, electric vehicles, and advanced electronics. In 2026, industry analysts projected a global supply shortfall of around 150 to 200 million ounces, a deficit that has persisted for years as mine output lags behind growing demand. Solar manufacturing alone now absorbs more than 15% of annual silver production, while electric vehicle batteries and data centers push consumption even higher. Despite these shortages, paper contracts on exchanges can send the price plunging in hours, wiping out billions in market value. The disconnect grows sharper as physical buyers pay premiums for real metal, even as screens flash red. On the ground, scarcity is the rule, not the exception. SLV, the world's largest silver exchange-traded fund, traded at a 19% discount to its metal value on January 30th, 2026. While retail investors watched prices collapse, authorized participants moved fast. In a single session, they created 51 million new SLV shares, an arbitrage window worth about $765 million. Only large institutions have the tools to exploit these gaps. They buy discounted shares, redeem them for physical silver, and pocket the difference. Creation and redemption filings confirm the scale of this activity. During the chaos, the disconnect between paper and physical markets became a source of profit for those with privileged access. Right now, silver's real-world demand outpaces mined supply, yet prices remain hostage to paper market mechanics and sudden rule shifts. As long as power tilts toward opaque exchanges, transparency lags behind volatility. For anyone holding real silver, the true value and the real risk remain unresolved. Share your thoughts below.